Moving on now to look at bonds. As I said, bonds are loans to governments or corporates, and they're represented by pieces of paper, digital pieces of paper these days, and they generally pay a fixed interest based on the initial issue price, and they are redeemed at face value at maturity. And there are two main drivers of returns when it comes to bonds. There's credit rating. So obviously the better the credit rating of the issuer, the lower return they need to offer to get you to buy them. And the Australian government is one of the highest rated governments around the world. And so Australian government spreads or interest rates are lower than many other countries. So if you want to get more return, you can move up the risk curve, that is, buy bonds issued by more riskier issuers. But that sort of defeats the purpose of small parts of bonds in a largely growth portfolio. So if you've got anything above 70, 80% growth in your portfolio, you really want to be looking at extremely high-grade bonds, which in an Australian context means government and our banks, and some corporates with sufficient rating. When you move to a more conservative portfolio where you're looking for income, then you can move up the risk curve. The other thing that drives returns in bonds is duration. So a 10-year bond should give you a higher return than a 2-year bond or a 3-year bond. The longer the duration, the higher the return you expect. And that's because you're taking more risk, you should be rewarded from it. So duration and rating are the two drivers of returns in bonds. But when we're looking at their role as a defensive asset, as opposed to an asset designed to generate income, we really want to focus on those high-grade local currency bonds to start with. As we move up down the growth percentage in a portfolio, then you probably need to start adding first global high-grade bonds and then lower credit rating or longer duration bonds. So there is quite a range of ETFs and managed funds available in bonds. It is an asset class where active management can add significant value. But active management when it comes to bonds is really factor investing. So it's really playing with duration and rating in order to generate higher returns. So there is no free lunch here. And most of the indexes tend to have quite long duration. And so that's a potential problem, particularly if you're starting to add more and more of them. And the other thing to watch with bond portfolios is that because the big banks have to hold a lot of it that they can then use to repo with the Reserve Bank, they tend to focus on the shorter term stuff. So the returns in shorter term bonds, particularly government bonds, is very low relative to what you can get in cash. So there's a lot of thought to putting together a bond portfolio once you get into significant levels of it. But if you're looking at an 80-20 portfolio, where you might have 10 in gold and 10 in local government bonds, the low-cost, easy way to start is to focus on a core composite bond ETF. And the two biggest ones are IIF, which is the iShares Core Composite Bond ETF, and VAF, the Vanguard equivalent. They both track the same index, the Bloomberg Ausbond Composite. And composite meaning it covers government and corporate, and it's 0+, so it starts with the very short end. And as we'll see in the chart in a moment, they perform almost identically. The VGB is the Vanguard Australian Government Bond, so it takes all the corporate out of that IF and VAF have, and that sort of reduces your return a bit. IGB is much shorter term, that's treasuries, so that's really short term stuff. And then we start moving into other variations on that. But when you look at portfolios, the lion's share of Australian bond portfolios for most people are either the iShares Core Composite Bond IF or the Vanguard equivalent, which is called VAF. And as you can see from this chart, they have performed statistically identically. You can't put the cigarette paper between them. So over almost 12 years, or just shy of 12 years, they've both delivered just shy of 30% return. So, when we're used to seeing double-digit returns in equities, this seems to be a difficult investment decision to make. But it's when you mix the two together, so some bonds and plus some equities doesn't actually give you the average of the two because they behave slightly differently. So for our portfolios, IAF or VAF are fundamentally identical. We tend to use IF because it's bigger as an ETF, but the Vanguard one is part of a fund. It invests in a managed fund, which is 7 billion. So they're the ones that we use. It's high-grade stuff, substantially all invested in A-grade or better, 70% of it in AAA. So this is really high-quality bonds. The only way you're going to lose money in this is by selling before the underlying bonds mature.